the Bitcoiners wonder, why don't all these investors buy Bitcoin? What happens next is some bullish things, right?
Welcome to Dream Richer. Have you ever wondered why no one can give you an exact number of the current inflation rate, even though everyone agrees that hyperinflation and a possible economic recession is coming? However, every person will measure inflation differently. This is because inflation is individual to each consumer. Hence, no one can measure it on a global scale. As Saylor argues, inflation hits investors the hardest compared to someone who just streams YouTube or Netflix all day. This, however, raises a very interesting question, which is, who does inflation affect the most, the poor or the rich? On face value, it's understandable how inflation can hit the lower class. For example, rents are rising at a rapid clip due to the mix of rising demand and bottleneck supply. This puts the poor at a large risk. And if poorer people are trying to live somewhere relatively prosperous, perhaps to enjoy future economic mobility for themselves and their children, then rising rent will eat up an especially large share of their incomes. By the end of this video, Saylor unravels the mystery of a current economic state. If you find the video helpful, then don't forget to subscribe. Let's get right into it.
The reason that I was sensitive to inflation was I immediately saw the inflation in March and April in the stock market. If I were to go to all my investors and say, I got $500 million, I'm investing it at 2% interest, and inflation rate's 1%, they wouldn't have given me a pat on the back. They would have said, the S&P index is moving up 10% a year. Your hurdle rate, your cost of capital is not 1% or 2%, it's 10%. And maybe you're getting 5% yield on a piece of debt, then I don't hold my nose, but you're losing 5% a year. Half-life of the money is 12 years. Okay, fine, but like you shouldn't be holding it. You should be buying your stock back or buying another company with that. Sitting on that cash it doesn't make any sense. I say this oftentimes, inflation is a vector, and what I mean is you got to use multi-dimensional arrays and linear algebra to even start, n-dimensional linear algebra to even start to deal with the issue. Another way to say it is you can calculate a different inflation rate for any person in any jurisdiction based upon their mix of products, services, and assets they want to acquire. And so common sense says a person that wants to acquire a set of manufactured goods and wants to watch streaming YouTube has a lower inflation rate than someone that wants to buy Picassos. Now, what if you want to be rich? If you want to be rich, your inflation rate is very high because you have to acquire assets. If you want to be middle class, your inflation rate is different. Back to why I did what I did. If you're the CEO of a publicly traded company, your inflation rate is the cost of capital. And the cost of because your shareholders hold you to that cost of capital. If I go to a public investor and I tell them my goal is 2%, and they're saying, well, the S&P is up 14%, then I'm undershooting their goal. Their index is the S&P index, right? Correct. So if you convince yourself that the inflation rate was 5%, or if you convince yourself that you could say, look, my treasury index is just the short-dated sovereign debt index. And so as long as I'm beating the 20 basis points, I'm good. And, by the way, like if I have a bunch of money sitting in a bank, my bankers come to me. I've literally had bankers from the big wire houses. They came to me when I'm sitting on 100 million or 200 million in cash, and they go, we can get you into one of our money market funds that'll yield 22 basis points. And that's much better than the 9 basis points. And they're selling this to me. There are people in suits that make a lot of money, and they're selling it to me. And you read the prospectus, and the prospectus is they're going to do something, and they're going to charge you a 27 basis point fee to generate 22 basis point yield to you. You're literally...
They're making more money than you are.
You're giving 60% of the yield to someone in a suit that's giving you a service to get you 5 basis points more. But there are people that convince themselves this is a good idea.
Since 2001, the US dollar has lost half of its value every 4 years. Of course, its actual value moves up and down, but it tracks very close to this decay line. There is nothing natural about this decay curve of the dollar. It is the result of carefully crafted monetary policy. Central banks wield huge power over the value of their currencies. If debasement is pushed too hard, people may lose confidence, leading to a dollar collapse. But to reverse the trend would push interest rates sky high and result in monetary chaos as well. Hence, a continued steady devaluation of the dollar is likely the best case that central bankers can achieve as of now. So far, we can't see any way that this can end well for dollar holders. Perhaps the Feds can eventually make the USD redeemable in gold again.
Let's start with the most basic issue. Is Bitcoin an asset or a currency? The word cryptocurrency is a very politically charged word because if Bitcoin was a currency, it's in opposition to the US dollar, okay? And if it's an asset, it's in opposition to gold. Okay, so just resolving the fact it's a digital asset, not a digital currency. Most people's, how many public speakers, how many well-regarded investors have made negative comments about Bitcoin over the past 12 months because they mistakenly think it's a currency and they think they're sticking up for the dollar, right? Many, like, I prefer the dollar. So if you understand it's a digital asset, a scarce store of value, speculative digital asset, that's how politically correct people would refer to it, right? And anybody else would say it's just a digital asset or a store of value asset. The first impediment is just understanding that and educating the market that it's a digital asset.
It's clear from Michael Saylor's explanation that Bitcoin is the best hedge against inflation. While high inflation is generally considered harmful, some economists believe that a small amount of inflation can help drive economic growth. For example, inflation makes it easier on debtors to repay their loans with money that is less valuable than the money they borrowed. This encourages borrowing and lending, which increases spending on all levels. Simple put, more dollars translates to more spending, which equates to more aggregated demand, hence giving the economy a short boost. This boost, however, is only temporary and eventually bursts like a bubble at one point when the economy slides into hyperinflation. Do you agree with Michael Saylor on a bullish crypto future? Let us know in comments below. To learn more about the latest crypto news, watch these videos here.